Good day, subscribers. Welcome back to the Contrarian, everybody. Today I'll be talking about a question that often has come up for me in just talking with friends or other people in the last couple of weeks or the month, at least, in terms of why is the market, accelerating to the upside, even though it's overvalued according to pretty much most, uh, objective assessments of the market, whether it's the Buffett indicator, looking at the PE multiples on the NASDAQ, the S&P 500, looking at the underlying economy, how that appears to maybe not be doing so great. Why is the stock market maintaining this elevated level? Why has it not started correcting yet? Why is it even perhaps going to accelerate to the upside? And then also, conversely, I'll talk about what it would really look like when we're at the top of this trend right now, because the trend actually in the last couple weeks does appear to show that we might be in a new bull market. Now, this bull market might not last very long. It might be a 6 month to 1 year bull market, but it is nevertheless maybe a new bull market. That's what the technical indications are showing anyway. And so going long that kind of a trend, I'll talk a little bit about my positioning as well later on, but first off, why is the market so overvalued? Why do investors seem to not really care about that? And a lot of this has to do with psychology of markets, which is maybe a better way of looking at markets than just a fundamental assessment on its own. Because fundamentals, yeah, they've been overvalued for quite a long time at this point. You might be able to argue that since, the 2008 recovery, the economy wasn't that strong. It never really got that strong after the recovery. Why did the stock market have such an amazing rally after that when a fundamental assessment might not have maybe given you that analysis or that takeaway. So a lot of it does have to do with the psychology of markets, how a market cycle is very much so a psychological cycle. There's different points at which psychology changes, and that is very key for how markets behave, because markets are driven simply by people buying and selling. Whether that be influenced a little bit or amplified by what the Federal Reserve does, it's still people, investors, whether they be just your average people investing for themselves, hedge fund managers, pension fund managers. It's simply people making decisions that drives what a market does. And so, yeah, looking over the last 2 years, for example, 2022 to now, investors have been very cautious, you could say. There definitely has been a sense of anticipation of a recession, anticipation of lower prices, and so therefore investors have allocated more of their incoming capital simply going into cash or other more safe haven type of investments. Obviously, the dollar did very well in 2022. Energy did well, but the stock market overall did not. It was down about 30% on average, and so yeah, about a year ago, investors were very cautious. Even up until now, just talking with people is a great indication. What I like to do, just asking them, maybe it's friends, acquaintances, they don't maybe know me as well, and so just getting to hear what they are allocating capital to if they, do investing for themselves. And oftentimes the answer recently has been, well, it appears like everything's overvalued, so I'm just putting a lot of it into cash. Maybe I've, bought some bonds recently. Maybe I bought a few more defensive stocks, um, things like that. So, in my mind, even though there's a lot of maybe more froth that can be seen recently in maybe the crypto space or the SPAC space or some of the meme stocks that have kind of come back to life recently, in my mind, that's not a mainstream. That's not a sign of, this speculation, this return to the broader market. It's more niche. It's more reserved for kind of these, unique situations right now. So even though there's a lot of news surrounding, the latest meme stock that's up a couple 100%, that's not like it's everybody buying into that. It's not like that's affecting everybody who's investing, who's just been allocating cash in the last year. There still is a lot of cash on the sidelines in my kind of assessment. There's a lot of maybe fear greed indices that aren't as great at measuring that, in my opinion. They tend to maybe more focus on, again, kind of more the unique speculation, not what your average person is actually doing. So, in my assessment from what I've seen so far, it does appear like there is actually still a lot of liquidity on the sidelines, investors who have not jumped in. And so, in my mind, this is really why the market is continuing to rally to the upside is investors are kind of starting to question, well, if this really is a new bull market, then I should go long. Looking from 2010 to 2020, that was an amazing time to be in the general stock market. And if the broader, population begins to think that we're in a new extended bull market like that, that if 2022 was all that, this kind of recession is going to bring in terms of a market correction, then you're really going to start seeing people get back into the major market indices. You'll start see the inflows of going into passive ETFs, even some actively managed ETFs. You'll start see those inflows go up pretty dramatically. Now they have been accelerating some in the last few months of this year, net inflows, which is kind of a sign that this trend might be starting to accelerate and get going. But once that really gets going, investors start being more aggressive in their allocation, not as much cash, not as much defensive. Yeah, once you start to see things like that, you really could start to see these indices take off. So yeah, you could see NASDAQ, S&P 500 perform very well, but how I'm personally allocating for this is looking at a lot of these smaller cap stocks. So for me, this has been Overstock and Big Lots in the last few months, adding to these, looking at these more stable retailers, definitely smaller cap retailers, how they behaved after 2020, the correction there. They rallied significantly to the upside. This has to do likely with the fact that there was some short interest on both of these stocks back then. There is now as well, but also they are smaller cap. So when the passive ETFs have inflows, this will perversely affect the smaller cap stocks because you just have a smaller size of pool basically for money to go into than if you're just allocating passive money going into Apple or Google or a big stock like that. So um, even though it might be a little unusual, I would not be going long these stocks if I didn't think the market indices were going to continue to see inflows as well. That's kind of how I've personally maybe changed my investing strategy with what I see maybe coming up here this year. So whether you do something like that or not is totally up to you. This is just maybe talking about what I have maybe shifted a little bit in terms of my strategy here. You could also make the case for going long the indices. I have done that a little bit as well, going long semiconductors. But yeah, so you could make a case for going long an indice as well. But yeah, all that being said, that's kind of how I've maybe changed my strategy in response to this. Now, when does the market top out? Another psychologically driven and psychologically answered question. I would say that when you start seeing people being all in, going along the market, when you start seeing the market make new all-time highs, that's definitely going to draw more people in because at that point they're going to say, okay, it's official, we're in a new bull market. Everyone, we all need to go long. We need to be in 100% stocks or most stocks, mostly stocks, probably some bonds too as well, since the yields on those are still elevated. But yeah, you'll see a lot of people get out of cash. There won't just be as much liquidity on the sidelines, and most of all, you'll see the enthusiasm go through the roof. So you won't really see people talking about fears of a recession, fears of a correction in the stock market, fears of a crash, anything like that. So at that point, you would be close to getting to the top that the indices would put in, and at that point you could actually have some risk of a crash, uh, of a sizable proportion happening, because at that point, that is historically when we've had all of these major corrections afterward, is when everybody is so enthusiastic about something. They're enthusiastic about, technology in the dot-com era, enthusiastic about real estate, and the strength of the real estate market in 2006 to 2008. So that would give you kind of an approximate timing for when the market would be at, its highs, which I don't think is right now. I think it's a bit further down the road that we get there, just looking at how much liquidity people have built up on the sidelines. So all that being said, that's kind of my take in terms of why the stock market has done well so far this year, why why it's continuing to maybe accelerate to the upside, why I would kind of expect that due to psychological behavior, due to liquidity still being out there. Also looking at how I've kind of positioned myself for that, going long small cap stocks that'll benefit from inflows, passive inflows, also that just have decent underlying business fundamentals. They don't have to be great, but yeah, all that being said, let me know what you think about all of what I just said down in the comments below. I'd love to hear your thoughts on all of this. If you like this video, just consider subscribing to the channel, and hope to see all of you again at some point.